I'm Greg Hunter. Welcome to USAWatchdog.com with all the good news about the economy being put out by the White House. And there is some good news, there's no doubt about that. But I've had people ask me multiple times, hey, could you bring John Williams from shadowstats.com on and give us the real numbers? So your wish is my command, audience. Here's John Williams from shadowstats.com. John Williams, thanks for joining us today on USAWatchdog.com.
Thank you for having me, Greg.
You're the guy that takes the the old school way of looking at things without all the gimmicks and out all the lies and the numbers. And I want to start on Election Day. Election Day 2016. If Hillary Clinton would have stolen enough votes to win, we would be in a full-blown depression right now, would we not?
Most likely, I'll contend, though, that we're already in a recession and at the end of the Obama administration. That's one reason that Donald Trump got elected. The average guy was not doing well in terms of making ends meet, and the finances will drive elections. They have historically. If Main Street USA is suffering economically, they'll usually turn out the incumbent party in the White House.
Now, Trump has done some good. There's no question. I mean, you were popping 23% at shadowstats.com. I think it's down to 21.5 on the official numbers. The real numbers, the way they were done in 1994 and earlier. But he has done, brought money back. He's cut taxes. He's done some things. That's why I'm saying if we'd have had, the Democrats and Clinton in the White House, they wouldn't have done any of that. But things aren't as good as the White House is making out. And the consumer is really what you called in one of your reports in a liquidity squeeze. Will you please explain the liquidity squeeze for consumers?
Sure. When you look at the consumer drives the economy, that's the consumer is 3/4 of the economy. And in order to grow consumption, in order to have a happy lifestyle, usually people like to have growing income and generally growing liquidity. There are a couple of ways you get that. Number one is income, and if you look at real earnings as published by the government, we've seen this is now adjusted for their inflation. You haven't had any meaningful growth in real earnings, and in fact, for the production and non-supervisory workers, their real earnings have declined for 3 quarters in a row. That's not a happy circumstance, not one that would generally drive the economy in a positive manner. If you don't have the income, you make up the difference when you can, if you've got to spend the money, by increasing debt. But what you'll find is that consumer credit outstanding, adjusted for inflation, also is not growing. And that's largely due to Fed policy. Banks are still not lending normally. We've never recovered from the banking crisis. Nonetheless, the economy is off bottom. The things done by the Trump administration have been a plus. But frankly, the president has not had a fully cooperative Congress. Had he had a Congress that joined him that was looking to make changes the way he was talking, you'd have a much stronger economy now. We'll see how this upcoming election goes. But at least things have improved some, but it's not quite as good as advertised. And there are all sorts of danger signs right now.
I've been on Deutsche Bank. I don't know how much I know you're not really a bank analyst, but Deutsche Bank, I mean, they got put on the the Federal Reserve watch list, the U.S. version of them anyway, which they're a big global bank. They've been caught, in all these Forex and LIBOR and gold and silver rigging scandals and crime, actually. Then they had this 12 times value at risk, I call it VAR, value at risk loss. Recently was disclosed in the first quarter, and they're just getting gut punched. Is Deutsche Bank the poster child for what's wrong with the banking community? It's people will tell me it's not just Deutsche Bank, it's all of them. You're just seeing Deutsche Bank as the canary in the coal mine. Are all the banks as bad, or could be as bad as Deutsche Bank?
Well, I don't know if they're all as bad as that, but I can tell you that the system has not recovered fully. If you go back to the end of 2008, when the banks were literally on the brink of collapse, the Federal Reserve, the Treasury, the Congress did whatever they had to do to keep the system from collapsing. They didn't want the banking system to collapse, and that's understandable. I mean, that would have been an economic disaster. Uh, but in order to do that, they did extraordinary things. They created whatever money they had to. They guaranteed whatever they had to. They bailed out whatever they had to. They bailed out General Motors, and the Federal Reserve bought AIG. They bailed them out because they were insuring these credit default swaps that failed and helped to trigger the banking crisis. Whatever they had to do to keep the banking system afloat, they did. And the Fed created trillions of dollars, which where it bought bad loans off the books of the banks, as well as some treasuries that normally would have flooded the system with tremendous money supply growth, but they wouldn't let the banks lend the money out. The banks had to put the cash that they had back at the Fed, earning where they earned interest as excess reserves. But that money didn't get into circulation to stimulate the economy. What the Fed did to save the banks was to save the banks. It was not to stimulate the economy. If they wanted to stimulate the economy, they would have let the banks lend more money. Now they're backing off of that quantitative easing, as they called it, and they're beginning to tighten up on the liquidity in the whole system. And that, in fact, is going to drive the economy deeper into downturn. It's going to the extent you might be on the plus side now, give it another 6 months with the way the Fed's raising rates, and you're going to see the economy in a pretty bad recession. So that it's that they're not that they're trying to get the system back to normal. But it never got out. It never really recovered from 2008. The banks are still in trouble. If they were not in trouble, they'd be lending normally. They're not lending normally. People are still having trouble getting mortgages and such. It's not a stable circumstance, not a happy circumstance, and the Fed doesn't have full control of it. And therein you have all sorts of problems going into the future with the economy.
When you talk about liquidity, does that mean the common guy on the street can't get loans? Guy building a business can't get loans? I mean, that's a big drag on the economy too. If that's part of the liquidity squeeze, is that part of that?
Yes, I mean, again, consumer credit outstanding, which could help support the economy, is in contraction, adjusted for inflation. The Fed's showing that in their numbers, and that's using headline inflation. That's not using a real inflation number, so it's a problem, and it's doubly a problem because you're now beginning to see a resurgence in inflation, in the headline inflation.
Yes, let's talk about the real inflation and the government inflation. What does the government tell us we have inflation, and what's the real stuff?
Well, right now you've got the year-over-year CPI up around 2.7, 2.8%. That's the highest it's been in some time. I think the average person will tell you that inflation's understated by maybe 4 or 5%. That would be consistent with the changes that the government made in cutting inflation since 1990. It's actually a little higher than that. It's up around 7% differential. If you look at the changes made since 1980 to understate inflation.
So the real inflation rate is not 2.8% that the government says. The real inflation rate you're telling me is somewhere north of 9%.
It's if that would be the real, the way it used to be in the 1980s. That would have been the common experience from the 1980s.
Wow.
but since the 90s, it would be maybe in the 6% range, so 6 to 9%.
So the real inflation rate is, if it was done the way it was in, I'm gonna get this. I just want to get this straight. If it was done the way it was done in 1980, around 1980, the 80s,
Right.
it would be close to 10%. The real inflation rate is what you're telling me.
Yeah, it would be, but there are different factors involved here, and again, as you look at the headline numbers. The Fed says, "Oh, we want to get interest. We want to we'll raise interest rates because inflation's picking up." Well, they're raising interest rates will tend to cool the economy, and that's normally if inflation were getting higher, the Fed might raise rates to cool the economy, and that would bring inflation down. But guess what? The inflation we're seeing here is not being driven by a strong economy. It's being driven by oil prices. There are different types of inflation. Some are better than others. Now, for the average guy, if you have inflation that's being driven by a strong economy, there's some positive elements to that because along with the inflation, usually wages are rising, income's rising. But that's not happening here. So that as inflation increases, whatever measure you're looking at, it's going higher. When wages are not rising, what that's doing, it's cutting the purchasing power, the real purchasing power, the amount of goods that people can buy for their not growing income. So that actually damages the economy. The inflation that we're seeing here is a negative for the economy. Because it's being driven by oil, not by a growing income or demand, and at the same time, the Fed is raising interest rates to cool the economy, overheating economy. It's not overheating. It's positive, but it's not overheating, and there are elements of the economy that still have never recovered from the collapse into 2009. It's a very unusual, but also a very dangerous circumstance in terms of economic policy, and certainly in terms of the financial markets that seem to think everything's just fine and dandy here. It's not fine and dandy. We have some major issues, and they need to be addressed.
This is your not. Well, how would you address him if you were Donald Trump? What would you do? What would you do if you were the economic czar? You were Steve Mnuchin. You were in Donald Trump's ear saying, "Prez, here's what you got to do." What would you tell him?
Well, you need you need things such as tax cuts or.
Yeah, what would you do to get the economy going?
Let me put it this way. You need to bring the budget deficit under control. That sounds crazy. That's not what you would normally do. Normally, you'd increase deficit spending to stimulate the economy, and that's probably what needs to be done here. And we're beginning to see that, although I wouldn't necessarily do it the way they're doing it. But the problem remains is that you have a severe deficit problem in the United States long term. We have all sorts of unfunded liabilities with Social Security and Medicare. You're looking at close to $100 trillion in terms of today's net present value, the cash you need in hand today to keep the country solvent long into the future. There's no way we can possibly raise that money. You've got to bring the system into long-term balance. And if you have the system in long-term balance, that's number one. Number two, then you have the ability to increase the deficit spending in a relatively positive way and stimulate the economy. Let me be a little more specific there. In terms of the global markets, big factor for the U.S. dollar is the long-term solvency of the United States, as it's perceived, the sovereign solvency. If the government, I'm talking here both the executive and legislative branches, if they can get together and put together a credible package for maintaining long-term solvency, bringing the system into long-term balance, uh, that would be a big plus for the dollar and the currency markets, and that would then allow for short-term deficit spending and increase there to help stimulate the economy. Um, the markets would buy that. They wouldn't crash the dollar. You don't want the dollar to crash because that's going to kill your financial markets. All sorts of dangers there. The other areas which the president is beginning to address are in terms of the trade deficit. The balances with the various trade partners, trade deals, where over decades, and you can go back to NAFTA in 1994. That's when they redefined the unemployment rate to make it look better, to get the discouraged workers out of the way, because although they still counted discouraged workers, they dropped them from the accounting after a year. If you were a discouraged worker for more than a year, you're no longer counted as discouraged now. Before 1994, you were. So as a result, if you look at the discouraged worker unemployment rate, which is say the headline unemployment rate right now is something like 3.8%, it's the lowest since 1968. If you look at just the raw numbers. You're up in the 9% range with the discouraged workers marginally attached. But if you counted all the people that are long-term discouraged, displaced workers,
like they did in '94 and earlier.
Yeah, but yes, that you'd see unemployment up around 20%. Now the difference here is that when you see the headline unemployment at 3.8%, that's a wonderfully low number. You should have, at the same time, a very high labor force participation rate. That's the total of the employed and the unemployed against the population, or the employment to population ratio. That the higher that rate, the better. Problem is that since the Great Recession, as some call it, those numbers tanked and have been at near historic lows, and they're still there. They're suggestive of the economy, the employment circumstance still being in serious trouble, but you're certainly not seeing it with a 3.8% headline rate. And even the U3 rate, excuse me, the U6 rate, the one with the discouraged workers, that's near its relative level back before the Great Recession began. But if you look at the long-term discouraged workers and displaced workers, that's consistent with the population. The employment to population ratio. So that what you're seeing here is that you still have a significant part of the population that is displaced, suffering economically. And that these are the people that, again, voted for the change in the White House. Now, how do you address that? Well, part of it is to bring the trade balance into at least much more positive. Again, we're basically at record levels of deficit now, and at the same time.
So Trump knows this. This is why he's doing all these threats of tariffs, and he's bringing jobs back. He knows this. This is why. He knows that he needs more jobs in America. That's what the whole deal is, right?
He's moving in that direction. The problem is he doesn't have much cooperation in the business community or Congress. I mean, the people who pushed for these trade deals have been controlling the government for the last
And like Jeff Flake's talking about how they want to hold up Trump on the tariffs. I mean,
Yep.
you got Congress holding him up. He's a Republican.
Well,
So you're saying these weasels in Congress on both sides of the aisle are covertly blocking Donald Trump. They don't want people to have jobs. That's what you're telling me.
well, their motivation is not to provide those jobs.
Wow. Wow, you got people in Congress working against we the people.
Yeah.
That's unbelievable. I'm furious hearing that. That
Yep.
that people that are smiling in your face all the while they want to take your place, backstabbers. I mean, they're stabbing us in the back with their cushy salaries and their insider trading. Congress, mainly the Senate, people like Jeff Flake and Corker and McCain. Right? These are all Republicans.
Yeah. Well, yes, it's. Let me put it this way: Mr. Trump was something of an anti-establishment candidate, and the establishment had been in place on both sides of the aisle for a long time. Media's been has had decades to adjust to this outlook as well, and now you have someone who's trying to change the general approach, one that's needed to get the system back on a stable footing. And as a result, you've had extraordinary turmoil in the press, a lot of opposition in Congress on both sides of the aisle.
Working
But
against
you
the
also have
president.
some support there, and that's where this next this midterm election is going to be interesting because my betting is that the same people that voted for Mr. Trump for president are sensitive to the fact that he's run into a lot of trouble here, and had he run in a campaign where he had a slate of congressional candidates that were looking at the same thing, this might have gotten off on a little faster footing. But there will be more people running for Congress this time around who are aware of what needs to be done, and I think you're going to have some surprises there that will help the president.
The dollar, you said in one of your things about the dollar's day of reckoning. I mean, for a long time you said there's, I don't know, 16, 17 billion, excuse me, yeah, billion, no, trillion, held outside the country. No, 16, how many billions are held outside in the country in liquid dollar assets? I'm sorry.
It's in trillions.
It's in trillions. It's okay, 15 or 16 trillion. It's a lot of money held
Yeah.
outside the country. I heard some of those people, mainly China and Russia, are selling our bonds. Is that
Yep.
what you're hearing too? Are they selling our bonds?
Well, you're seeing that increasingly, and again, this is the reason that you want to have long-term solvency in place. You have to. You need to have a Congress that will work with the president to bring the system into long-term fiscal balance. And if it's in long-term fiscal balance, you can sell the dollar. I mean, you can sell the dollar as this is where you want to have your money. And if you've got the world that is willing to put their money in the dollar, they're also willing to buy your bonds. And that's where you can work a lot of stimulus. But you have to address the long-term problem. And the Congress is not in a position to do that. Now they're just borrowing from the future. They continue to expand the budget deficit.
Well, Richard Burr just voted with the Democrats. They could cut $15 billion. And Richard Burr, another Republican, just voted with the Democrats. Oh, no, we're not giving that back. No, we're going to spend that. I mean, it's unbelievable. And it's both sides of the aisle here that are an impediment because they're so, in the swamp, bought and paid for, bought off, have a control file on them. I mean, Congress is disgusting.
I can't argue with you.
Okay, all right. Can you add to that? My comment, Congress is disgusting. They're basically blocking Donald Trump. I mean, some of the biggest blockers are the people in his own party and the other party. You think they'd want we the people to do well, but no, they'd like to import all kinds of foreigners and have open borders so other people do well and us pay for it. It's just unbelievable what these weasels are doing.
Yep, it is.
Could you ever foresee a time where we could default on our debt? I mean, I know people. No, I mean, but I mean, if Deutsche Bank goes down and we get a big crash in the markets and things go haywire, could we end up defaulting on our debt, the U.S.? And if not, could gold and silver go sky high, or will it go sky high? Default on the debt, will gold and silver
Well,
go sky high? Let's start
let
there.
me let me put it this way. Back when Standard and Poor's downgraded the credit rating of the Treasury bonds some years ago, I guess
That's what.
almost a decade
Yeah,
now.
yeah, yeah.
Alan Greenspan said, "Oh, it's nonsense. The U.S. will never default on its debt. Can never default on its debt because its obligations are in dollars, and we can print as many dollars as are needed to pay off the debt." And that's true. The reason that you had the downgrade there, the downgrade or the rating is a measure of risk of default, or perhaps better, the risk of default is very, very small. You get a real high rating. And you had some people in Congress at the time who were talking about a government shutdown and perhaps even defaulting on the debt deliberately, um, as part of the pressure to get this package in place. That increased the risk of default, and that triggered the downgrade. So the U.S. bonds no longer are AAA rated. It used to be the global benchmark. Uh, but yes, I mean the government can print as many dollars as it wants and always pay off its dollar debt. Problem is that right now, where we have, let's say, $100 trillion in obligations, today's value of the money, uh, to print that money is going to give you a very high inflation, hyperinflation. That's where eventually it goes. And in that type of a circumstance, yes, the precious metals, gold and silver, will retain their purchasing power uh, against against what the dollar currently buys today, and it's a way of preserving your wealth and assets. I'm still looking at that. I've been looking at gold as long as we've been talking, and it hasn't rallied as I had thought, but the inflation has stayed under control somewhat. And there's been a lot of intervention in those markets, but fundamentally, long term, the best bet you have is that we're going to see a much weaker dollar in the future, higher inflation, and your insurance against that remains gold and silver.
If we get into trouble, we get a big market crash, particularly going into the fall of this year or maybe this summer sometime. Do you see the Fed doing an about face and say we're not going to do any quantitative tightening? Matter of fact, we're going to cut rates a little bit. I mean, do you see the Fed going, doing an about face if we get into a pretty stiff, fall into a pretty stiff recession? Now you say we're already in one, which sounds to me like we're sliding
Well,
into one deeper. Do you see the Fed doing an about face if we continue to slide into recession?
yes. The reason the Fed launched its quantitative easing was to keep the banking system afloat. Again, it wasn't to stimulate the economy. The Fed's primary function in life, they say, oh, we've got a congressional mandate to uh, have a strong economy, to keep the economy going, to keep inflation contained. But the Fed's primary function is to keep the banking system afloat. They can't let the banking system fail. So what they did back in 2008 and in the decade that followed was basically keep the banking system afloat, even at the expense of the economy. There were things they could have done, such as allowing greater lending and a greater increase in the money supply, that would have helped to stimulate the economy some, but they didn't do that. Their focus was the bank. Now, the banking system. Now, the problem with what was happening at the time was that the banks were facing a solvency crisis. If you have a weak economy, people default on their loans. It tends to put liquidity stresses on banks, increases solvency risk, and the economy is turning. down anew, and I think it is. I mean, there are all sorts of indications of that in terms of where, particularly with the consumer. I mean, again, the consumer drives the economy. Uh, you're going to be seeing the headline numbers turning lower again, and as those headline numbers turn lower, the Fed is going to have to pull back in order to uh, put a little more liquidity into the banking system. It doesn't want the system to fail. It doesn't want to see a replay of 2008, but it's never fully recovered from 2008.
So
That's
they'll live with
that,
the inflation,
sure.
and they'll have to live with the spike in gold and silver price.
Well, yeah, that will happen. And the but in terms of the markets, if you consider right now, the markets are anticipating a rise in U.S. interest rates. We've been seeing the Fed hike the rates. That's a positive for the dollar, in that where the European Union, for example, says, "Oh, we're not going to raise rates for another year because we've got a real lousy economy here." Well, we have sort of the same thing here. Uh, but the dollar interest rates going higher relative, let's say, to the European rates, what you saw recently was that you get a spike in the value of the dollar.
They don't want that.
Well, this is what we've been seeing happen as the economy turns down. That's a negative for the dollar. But most importantly here, if the Fed backs off its tightening, moves back towards quantitative easing, which their minutes allow for. They have a problem again with the economy and the banking system. They can go back to the quantitative easing. They're going to do that. But right now the dollar is being supported by expectations of a higher interest rate, as the Fed moves back towards quantitative easing, you're very likely going to see a massive sell-off in the dollar. And the massive sell-off in the dollar becomes very inflationary. Why? If you look at and again, it's a problem right now for the Fed. What you're seeing right now in inflation is not inflation that's being driven by strong economic demand. It's being driven by higher oil prices. And usually, what we've seen in recent years is that the weakness in the dollar has spiked oil prices. So if you have a sell-off in the dollar, you're going to see a spike in oil prices. Now, what you're seeing in the spiking oil prices here at the moment is more political, and it's fears of what's happening in the Middle East and such. But you get a heavy sell-off in the dollar, which would come with the Fed moving back towards quantitative easing. You're going to see a spike in oil prices and a spike in inflation.
And you think the Fed's painted themselves into a corner? You think this is going to come sooner than later?
Yeah, that's watch the economy. You're already beginning to see it slow down. If you look at the first quarter GDP, and those numbers are so heavily inflated that it would be very difficult for those numbers to turn negative, but they're going to. If you look at the first quarter GDP, again, the consumer goods, they contracted in the consumption of consumer goods contracted in the first quarter. Residential investment, buying new homes, that contracted in the first quarter. That's a bad sign for what's happening to the consumer. And again, with income not growing, with credit not growing, and consumer confidence dropped sharply today, as I understand it. Those are all bad signs for what's happening to the consumer. And if the consumer's in trouble, the economy's in trouble.
And you think the Fed will pull the trigger sooner than later? They're not going to wait till fall. They're not going to wait until 2 weeks before the midterm elections. You're saying they are likely going to pull the trigger on the inflation numbers and back off and try to pump the economy up before the 2018 midterms. I mean, Powell is a appointee of Donald Trump. So you're saying that your bet is they'll likely pull the inflation trigger, the easy money policies, sooner than later. Am I wrong?
I'm not making a formal forecast in terms of the timing there. I think what they're going to wait for are some very overt signs that the economy's in trouble, and I'll contend that they're there. But where you start to see in the popular press, the economy's softening peak economy. The economists start talking about it, and all of a sudden you're going to have a shift in perceptions that the Fed's going to shift. And as soon as that happens, that's when things will start to.
We got a diving dollar and spiking gold prices is the overarching play. A diving dollar and spiking gold and silver.
That's the way I see things going. If the government can come up with a grand scale plan that can be sold to the currency markets as to long term U.S. solvency, then you have a way of pulling it around. And there were. You go back to the days of Franklin Roosevelt. He had fireside chats with the American people, and I'll contend that you could put in place a program that might call for sacrifices by individuals over time in order to bring the system into balance and to have long-term solvency and health for the U.S. economy. But you have to talk with the people and explain how the system's gotten so far out of whack, where it's going to go if it's not addressed, and we all pull together. We can have a circumstance that's positive going into the future. Will assure the ongoing economic health of the country, a healthy economy for our children and grandchildren, as opposed to one that increasingly gets driven into the ground by all the bad policies of recent years.
I contend that some of these people on both sides of the aisle border on treason. And maybe they are. You have people like Bill Maher hoping for an economic crash, but some of these guys on both sides of the aisle border on treason. They're so reckless. I mean, it's like they want America to fail so they can refashion it the way they want to have it, like Marxism or whatever crazy thing they want. That's just my opinion. I'm sorry. But you're the star here. And I want to talk about your shadowstats.com. You have had a major change in shadowstats.com. I think, if I'm getting this right, that you're going to have more reports, shorter, more pointed, more reports out, and less longer reports and more reports out. Is that what you're going to be doing? You're changing shadowstats.com. Still all the great information, all the real numbers, but you're going to be, like a machine gun instead of a 30-06.
Well, it'd be more like a machine gun. It's going to have the full coverage, but the reports will be more frequent. They'll be more concise. And I'm taking I have 70. I've had 70-page, 80-page commentaries. Parts of that have been on the consumer liquidity. Of a consumer liquidity watch. I've separated that out. That's now a separate document available on the site. I have a hyperinflation watch where I analyze the money supply and some of the circumstances we've been discussing here. I'm taking that out. That will be a separate document shortly, and I'm just about to go to press with the first revamped newsletter. I found from my subscribers that people were hoping for something a little shorter, more concise, and more timely. So that's what I'm doing.
Well, that's great. I mean, I've read your reports. They're very detailed. If you're investing big money, I don't see how anybody wouldn't be buying this for. Is that $175 a year? $75 a quarter. I don't know what it is.
$175 a year. $89 for 6 months.
Yeah. I got it right. I mean, cheap. I mean, if you're investing millions of dollars, what's $175 a year? If you get one thing that saves you $1 million, wow, you paid for that times I don't know how many times. Anyway, it's not just that. Regular people can buy it too. So anyway, I just really great stuff. I mean, the real numbers. I mean, people quote you all the time in articles. Bill Holter just quoted you because we have. We never really regained, is your premise, because of the real numbers, that we still are down 6% in manufacturing, and we're still down 6%. I think it's in manufacturing, to get that right. We're still down. We're still down since the 2008 recession, 10 years of this.
Since the pre-recession peak back in December of 2007, the way the economy is measured, expansion, you have a peak. You drop off, that's a recession. You hit a trough, then you start to recover. That's the recovery. You recover until you get to the prior recession's peak activity, then it's expansion. Now, the GDP has expanded by something like 16% This is a number that's a little gimmicked on the upside. You look at manufacturing, which is a major component of the U.S. economy. It's still 6% shy of recovering the pre-recession peak back in 2007. So I mean, we're not expanding. We've seen 125 months, consecutive months of non-economic expansion in manufacturing. That's part of the industrial production series, which goes back 100 years. It's a very good quality series. It is one that's really unparalleled. It's put up by the Federal Reserve, which is a little bit less political than the Census Bureau. But you've never had 125 months of non-expansion. That's longer than the first leg of the Great Depression. It's longer than the retooling of industrial production after World War II. Those are the two longest periods before this. Never seen anything like this before.
Wow. In other words, there's no real recovery.
There are areas which have recovered, I guess. I mean, you look at the numbers, but they've put a lot of gimmicks in the GDP. If you look at the series that are recovering, construction is not. I mean, you look at the construction, the housing numbers, you're down 20 to 50% below where the peak activity was before the recession. So there you've got two major elements of the economy. Now, if you look at the retail sales number, there you see maybe 7% expansion, but that's due to the nature of the inflation adjustment. They use the consumer price index, the headline consumer price index, to deflate that. If you understate the inflation that you're using to deflate something, you end up overstating growth. You look at the other measures, the consumer, what the consumer does, the consumer, various consumer measures. You're not seeing that real growth in the retail sales, but it's there. I mean, that's one of the things supporting the GDP. Then you have all the services side. So the healthcare, attorneys, stockbrokers. Those are areas that have been growing strongly in the GDP, but the underlying economy that most people deal with is not.
John Williams with the already good, but yet new and improved shadowstats.com. You guys should check it out. I'm going to put up the links to your subscription page and to your main page. There's some free information on there. It's pretty startling when you see the inflation numbers are way higher than what the government says, and unemployment and all that. Anyway, John Williams, shadowstats.com. Thanks for joining us today on USAWatchdog.com.
Thank you for having me, Greg.